So, what if you could take just $700 a month and turn it into over 80,000 bucks in just a little over 3 years? Well, in this explainer, we're going to do more than just look at the numbers. We are going to reverse engineer the exact math-based blueprint that made it all happen. And let me tell you, this isn't about getting lucky picking stocks. This is all about strategy. Okay, let's just start at the finish line, right? After 39 months of steady, consistent investing, this is the final number, $80,448. It's a really impressive number, for sure. But the real story, the interesting part, is how we got here. And here it is, side by side. This is the core of the whole achievement. The total cash put in was just over $27,000. That capital then grew and grew to over 80,000. I mean, we're not talking about a small gain here. That's a total return of almost 200%. Which, of course, brings up the big question. How is a return of almost 60% per year even possible? I know, it sounds like some kind of magic trick, but the source material we're looking at shows it's really the result of a very deliberate and repeatable strategy. So let's unpack the rules that made it work. So how did this whole thing even start? You might be surprised. It wasn't with a huge lump sum of cash or some super complex financial move. No, it all started with a simple, consistent foundation, a $700 a month experiment. And this timeline, this just shows you the incredible power of that simple consistency. For 39 months straight, another 700 bucks was added to the pot. That's it. No more, no less. And it was that discipline that built the $27,300 capital base that fueled this entire strategy. Okay, now this is where things get really, really interesting. You know, when most people hear the word options, they immediately think of high risk, right? But this strategy completely flips that idea on its head. It actually uses options as a tool to create a margin of safety. This one quote from the source material, it just captures the entire philosophy perfectly. It frames a choice. Would you rather just buy a stock and hope it rockets up 42%? Or would you rather get paid that same 42% as long as the stock simply doesn't collapse by 28%? That trade-off is the absolute core of this strategy. And this slide really puts those two choices right next to each other so you can see it. On the left, buying the stock, that's kind of like walking a tightrope. You need it to go up. But on the right, using this option strategy, it's like walking on a wide bridge with a giant safety net. By selling a specific kind of option, you get paid a premium right up front, and that creates this massive 28% cushion. The stock can go down, it can stay flat, and you can still hit your target profit. So the key takeaway here is pretty simple. The strategy isn't about getting rid of risk completely, because you can't. It's about structuring your trades where the odds are just heavily, heavily in your favor. You're literally engineering a buffer so you don't have to be perfect at predicting the market's direction to win. Okay, so this whole strategy is really built on two main pillars. The first one is aggression. But listen, this is not about being bullish and gung-ho all the time. It's about being aggressive only when the math is just undeniably, overwhelmingly on your side. And here you can see that principle in action. The portfolio manager doubled down on positions like HEAL and EPD because they offered just incredible upside potential. We're talking over 130 and 170%. But just as importantly, look at what they didn't do. They resisted the temptation to chase SoFi after it had already run up. Why? Because it no longer had that compelling mathematical edge. It's all about aggression guided by numbers, not emotion. And that brings us to the second pillar, hedging. I mean, generating big returns is awesome, but protecting those gains is every bit as critical. This is all about building a real, effective safety net for your portfolio. This quote right here, it reveals a really common and pretty dangerous assumption a lot of investors make. See, the portfolio had a hedge that, on the surface, looked like it offered $20,000 of protection. But when you actually did the math, it showed that in a real market drop, it would only provide a tiny fraction of that. This is exactly why you always have to do your math. So this chart just walks you right through that process. Step 1, they identified the flawed assumption about the hedge. Step 2, they ran the numbers for a real-world scenario, what actually happens in a crash. And then step 3, they adjusted the trade to secure the protection they actually needed. It's an active approach to defense, not just a set-it-and-forget-it thing. So, after applying all these principles, the cushioned upside, the selective aggression, the intelligent hedging, what does the final portfolio actually look like? Let's visualize the complete structure. So this is it. This is what the whole thing looks like when it's put together. And there are two things that should just jump right out at you. First, look at that massive slice of cash. Almost 38% is just sitting there, ready to be deployed for the next great opportunity. And second, the current positions hold over 41% in locked-in upside potential. So when you put it all together, that huge cash reserve, the built-in upside, and that separate $16,000 hedge we just talked about, you get what's called an asymmetric risk profile. All that really means is that it's a portfolio structured to win big, but also heavily, heavily fortified against losing big. Which really leaves us with a final question to think about. We're all taught to think of market ups and downs, volatility, as the biggest risk in investing. But what if the real risk is just playing the game without a clear mathematical edge? This strategy suggests that with the right blueprint, you can completely redefine what risk even means. And that's all for this explainer.